first, we start off with the markets. The Dow surging up nearly 200 points. The Dow and Nasdaq both locking in a 9-week winning streak. This as the U.S. and China inch toward a possible trade deal. Let's get straight to Eamon Javers in Washington for the very latest details on this developing story. Eamon.
Melissa, the president met in the Oval Office today with Liu He, the Chinese vice premier, as the two high-level delegations came together after a series of days here in Washington of negotiations at lower levels among the staff. The Chinese delegation announcing they're prepared to stay another couple of days here in Washington, D.C. to continue to hammer out some of the details. All of the rhetoric in the meeting today was positive about the chances for a deal between the United States and China before that March 1st deadline to raise tariffs. Here's how the president sort of handicapped the chances.
I would say that it's more likely that a deal will happen. The fact that they're staying, and this is a very high delegation. This is a man who is revered all throughout China as the vice premier. So the fact that they're willing to stay for quite a bit longer period, doubling up the time, that means something. I think there's a good chance that it happens.
So the president saying he thinks there's a good chance that the deal could come together. There was a strange moment, though, in the Oval Office when the president and his top trade negotiator, Robert Lighthizer, appeared to disagree about the need for a memorandum of understanding in this deal. The president is sort of expressing his disdain for memorandums of understanding in general. Lighthizer pushing back on that, disagreeing with the president, and then ultimately capitulating and saying we will not call anything a memorandum of understanding again going forward. So the president getting his way in a negotiation with his own trade negotiator there in the Oval Office as well, guys.
And I think he wanted to call it term sheet as they would like in a real estate transaction, Eamon. So I thought that was very telling in terms of what the president's context is in making a deal, so to speak.
Right. He brings a commercial real estate background to this,
right.
And that's his prism that he looks at this through.
But Eamon, in terms of Secretary Mnuchin's comments on making some progress about currency manipulation on the part of China, do we have any understanding as to what that might entail?
We don't. We're going to have to do a little bit more reporting to find out what the specifics are under that. But ultimately, I think the way to take all of this is a lot of positive rhetoric. Everybody is signaling that progress is being made. Everybody is signaling that we're getting closer to a deal. But as they say in these negotiations, nothing is agreed to until everything is agreed to. And that's sort of where they are. Ultimately, it seems that the president really wants to put the final ink on this deal, whether it's a memorandum of understanding or whatever it is in the end. He wants to do that face-to-face with Xi Jinping, and that could happen at Mar-a-Lago in March, the president said today.
All right, Eamon, thank you. Have a great weekend. Eamon Javers from the White House. And it has been a stock market battle royale between the U.S. and China. Check out where we stand right now. The S&P 500 is up 11% so far this year, while the FXI, the large cap China ETF, is up 13%, although it's still in correction territory. So if there is a trade deal, is the U.S. your best bet, or does China have more to gain? Guy.
I'm begging you, can you tell the crack staff in EC to please stop? I thought we established that this is a miserable song.
I actually requested it, knowing that you think it's miserable.
I'm not going to answer until they stop playing. I'll sit here all night.
Then I'll go to Tim.
Sit here in the
I'll go
show.
to Tim.
I would rather be in. No, go to Tim, but I'm going to give you a quick answer. There are two stocks I would rather be in. I would be in if there's some sort of deal. Assuming, and by the way, I'm not certain there's going to be a deal, but I'll tell you, Caterpillar would trade back to the levels that we saw in October, which is 155, and Wynn Resorts, which has had a tremendous run off 100, will trade up to about 155, 160 as well. Those are the two places I would go.
Two things that look very similar right now, commodities and China. And if you look at what's outperforming in this market, materials and China continue to be the story. And if you think about, we talk every day, what's rallied, what's still got some room to go. Obviously, emerging markets, China, materials, industrials are the ones that were most hit back in March of 2018. That, to me, is exactly where we're seeing the momentum. The FXI broke back above some key resistance today. Shanghai back above the 200-day, first time in a year. This is telling you that you're getting different market participation and different dynamics here.
Yeah, well, for me, my concern is that we might have priced a lot of this in, right? So maybe we get this pause that refreshes here. Doesn't mean that I'm necessarily bearish. It's just that in the U.S., we've priced a lot of stuff in. Frankly, even in China, we've probably priced a lot of stuff in. So instead of playing Would You Rather, I'll go with the brother from another mother and check out Europe. they've been hardest hit by this entire thing. China's their biggest customer. If China's going to recover, then Europe's going to recover.
You want Europe?
Yeah, Europe. So like Germany, if you want to do the ETF, EWG is the ETF there. The other thing that's great about going into Europe is you don't have the currency dynamics you have between the U.S. dollar and the Chinese yuan. That is likely to stay stable as Mnuchin cut a deal where Europe can probably cut rates, weaken the euro, and do pretty well.
The bad thing about going to Europe is that you've got a slowdown pretty much across the board, terrible PMIs coming out, and you've got an ECB.
It can only get better from here.
You've got an ECB with very few things that they can do at this point.
They can print all the euros they want. They've got TLTR, whatever it takes.
But your perception, Mel, by the way, is what the market thinks. The market, you had a bad EFO today in Germany. The data coming out of Europe over the last 2 quarters has been not great. I think we've priced in Europe not only grinding to a stop, but that actually have negative contraction.
You know, it's interesting. So what Eamon was just talking about, it's like a memorandum of understanding or something. It sounds an awful lot like after the G20 on December 3rd, the level of understanding we had about a trade deal with China. We gapped up that morning, and then we just flushed after it because people thought there was really no teeth to it and did not think that the Chinese were willing to kind of commit to the sort of things that would take to do a long-standing deal, not just dealing with the trade deficit. Look at the S&P 500, where we kind of stopped out here a little bit, or kind of touching on resistance, very near 2,800. That was the level in early December. So to me, you know, I think there is a lot priced in unless there is something very, very substantive.
You're acting like this trade deal is something that has to have substance. My view is that this is a trade deal that, you know, first of all, we're talking about currency manipulation. I mean, this is something we've either had the ability to argue about for the last decade and found some way to at times say this is not a big deal. Both sides want an opportunity for an agreement. This is going to be a trade deal. It doesn't matter what it is.
Isn't the currency manipulation thing just kind of a headline, right? As soon as we need to start easing again, won't we will be manipulating our currency? Isn't that what we did during QE? You know, I'm just saying, but it's all smoke and mirrors. These don't mean anything unless we address those really important issues about intellectual property and technology transfer. Those are the big issues. It's not
but from the market's perspective, Dan, it doesn't matter because I don't know that this administration is going to really push for protection on IP and fraud and all the other things that are, I think, both sides of the aisle.
Isn't that exactly what the economists are saying, though? These are the long-term problems that need to be fixed. It's not this trade deficit issue.
But from the market's perspective, let's just say there's no further escalation of tariffs. And let's say, best case scenario, the tariffs that were put in place in 2018 were rolled back. What would the market reaction be?
And the knee-jerk positive without question, understanding that we've rallied some 400 or so S&P points from the December 24th low. But then the next question is, and you've asked it, so I'll answer before you ask it again, is does that put the Fed back in play? BK would say probably no. And I'd say if you see a reacceleration, probably yes.
I think there's no shot the Fed comes back. I mean, they told us today that they're going to look for inflation that's going to be above 2% before they even think about raising rates again. So I think the Fed's out of the picture for 2019. I just think that we probably have priced in everything here. We know we're not going to get an intellectual property deal in the next 3 days. We're going to maybe get some kind of movement forward, but that's what the market's priced in. So until the market sells off, I think it's riskier to buy today, clearly, than it was a couple weeks ago.
Well, yes. So, but every time we think that the market can't go higher, the pain trade is higher. And I'm telling you, with expectations so low on global growth, I'm of the view, by the way, the Chinese economy in the second half of the year is actually going to reaccelerate. I think GDP is probably going to be 6.8, maybe 6.78%, which is above where it is now. They've cut rates. They gave you stimulus. They have triple R cuts. And I think the worst is priced in. It's the same thing with Europe. I'm not telling you it's great. I'm telling you, when markets are able to move higher, when they have moved higher in 2016 when there was no growth, it wasn't on, hey, earnings are going to be great and the global growth is great. It's that things aren't as bad as we thought.
So where in the world on a trade deal would you invest?
Listen, I think the U.S. is obviously, think about some of the businesses that have been hurt here since these tariffs went into place or since the fear of these tariffs. We would see, probably increased CapEx. We know that that's been a problem for much of 2018 that we're expecting. All of the benefit of the tax cut that was supposed to be in CapEx quickly got kneecapped as soon as the fear of tariffs came in and then once the tariffs did. So, to me, I think the U.S. trading at mid-teens multiple is pretty fair. The only thing that I get really nervous about is that here we are in the 10th year of this economic recovery, and we have a very dovish Fed where rates where they are, where all these things that they used to dot plot against and everything, they're moving the goalposts all over the place, and we have a 10-year Treasury yield at 2.65, and that doesn't say to me anything about reacceleration of global growth. It just doesn't say it to me.
It's not about that. Yeah, I mean, I agree with you. Stocks and bonds are saying two very different things. And this week tells you that tale. VIX hits 13. So eight straight weeks, I think, of markets moving higher, VIX moving lower. So, but that's the whole point. I think expectations are very different than they were 3 months ago. And that's from markets enough to keep them inching higher.
Right, and it's better if the Fed is easing for markets. We've known that over the last 9 years or so. That's the entire point. Actually, the whole last 30-year bull market is because Feds have been easing the entire time. So that's actually good for stocks. I'm not saying it's good for the world. It's good for stocks in the short run. But if you're asking other places to play that haven't necessarily run as much as the stock markets, why not energy? If we're getting reflation, if we're getting a turnaround in Europe and in China, and we're saying maybe it's going to spill over here to the U.S., you're going to need a lot more oil. And I think energy is the way to play. It hasn't completely run up yet.
Here's a plot twist, though.
I like when you do that.
A what?
The plot twist.
Oh,
a trade war with the EU. They just said today that they would target companies like Caterpillar, Xerox, Samsonite, if the U.S. decides, hey, you know what, we're going to put the auto tariffs on. They've got their list of tariffs ready to go.
That's the next. So if there's a deal with the Chinese,
then
you move on to the next thing.
It's like whack-a-mole.
But that's a fun game. I hurt my hand sometimes because you want to be so quick to whack the mole, and when at my age.
It's technique, it's not force. Anyway.
I'll say this. To answer your original question, I'll go back and say Tim would agree with this one. U.S. Steel was a $46 stock when President Trump started talking about tariffs this time last year. Traded down to $18.24 now. I think that's a stock that goes higher. But I'll just throw this in because why not? The Chinese have waited this long. They see what's going on here. I'm sure they watch 60 Minutes. They see what's going on in the landscape in the United States. Their markets have seemingly bottomed and recovered somewhat. Why would they be in such a hurry to make some deal when they can string this thing along? That would be my concern.